Welcome, everyone. I can see we've got a nice big turnout today to talk about pricing models and the Greeks. My name is Ed Modler, the Director of Retail Education at the Options Industry Council. A little bit about my background. I got started in the industry in 1997 after graduating from a University of Illinois with my degree in finance. Went right to the trading floor of the Chicago Mercantile Exchange, spent some time on CBOE. Also on the trading floors in New York as a professional options market maker for a number of years before trading independently. I also spent time as a futures broker and now for the past 5.5 years as an instructor for the Options Industry Council, or OIC, and this is what we do, is provide free education to the public on the listed equity options product. Today, I'm looking forward to and excited about talking pricing models and introducing the Greeks. First, our disclaimer: options are not suitable for everyone. They are a rather complex tool that should be well understood before using them in a live account. I'm not really going to walk through strategies today, more of a conceptual presentation, but any examples you see are for educational and illustrative purposes only. A little more about OIC and who we are. Going back to 1992, the Options Industry Council was formed to provide free and unbiased education to the investing public. We started out as an industry cooperative with our own staff and with exchange staff. Right now we are provided and funded by the Options Clearing Corporation, or OCC. You can find us at optionseducation.org. We've got plenty of podcasts, videos, and archived webinars. You can also take advantage of the Investor Services Desk. This is a free service we offer. Their email address is options@theocc.com. Send your questions to them, and they will help you out as best they can. They are not licensed to give guidance on what trades to provide or what trades to suggest, but they certainly can help you out with your questions. Also, we have a few team members from Investor Services behind the scenes here today. Ken and Bill are live. If you have any questions, type them in the Q&A box. Those guys will answer your questions live as the presentation is going on to the best of their ability. If I have any time at the end, I will pick up some questions as well. I also want to encourage and remind everyone to please take the survey attached to this presentation. We look at every single survey response we get, the comments, questions, and any suggestions. We read all of them, and it helps us shape the program moving forward. Before I get to the outline, I do want to take a look at where we're at in the industry because it's been such a crazy year. Looking at really this annual volume chart, 2018, 2019 is where we set records in this industry. And you can see on the left, billions of contracts. That's 5 billion where that number was. That record-setting pace in 2018 that we almost got to in 2019, that's right at about 19.8 million contracts per day on average to get that 5 billion number. Now, we know what's been going on in the markets in 2020. The reasons why this has been triggered have not been good ones. They've not been anything to celebrate, but certainly lots of volatility and opportunities in the market, and it has led to quite an uptick in options volume. Year to date, a little over halfway through the year, we're averaging 28.3 million contracts per day. Average that out, that is on pace to go over 7 billion contracts for the year. You can see just how far that is above anything that this industry has ever seen. In the month just concluded, June 2020, there were over 693 million contracts traded just in that 1 month alone. So you can see that the industry is doing well. And when the markets are at their most stressed times and investors are at their most stressed environments, dealing with their most stressed environments, they turn to the options product, and that's because of the benefits and the flexibility of the product itself. I'm going to start today's presentation with a few general words about pricing and where options prices come from, supply and demand, and then spend the bulk of our time looking at the pricing models and dissecting some of the math within those And then finishing up, defining all of the first order Greeks, not in too much detail, but a broad definition, none of which, nothing on this outline I think is going to be above anyone's head. At any skill level, you'll be able to absorb and understand most of the information we go through here today. One of the most common questions that I get from investors is with respect to pricing and the question of where do options prices come from? We see the prices on the screen, we see the bids and offers. Are they driven by market makers, or are they calculated, and where do they come from? Ultimately, all market participants, every buyer, every seller, that's you, me, and everybody else, all contributes to driving where options prices ultimately settle and how they move. So everybody who is involved in the industry is moving prices, sending bids and offers in, and options prices are adjusted accordingly. Ultimately, the forces of supply and demand are what moves options prices. I'm going to forecast the pricing models a little bit. As most of you likely know, one of the most important elements to options pricing is the concept of implied volatility. What is the expected future volatility in the stock that we're trading between today and expiration date? That goes a long way towards defining where the price is going to be, and it's an input in the options pricing model that you have to insert before calculating a price. And that level of implied volatility is moving constantly as these forces of supply and demand are inputting bids and offers. Reflecting back to when I was a professional on the trading floor, I never assumed that my implied volatility level was correct. I was monitoring the side of the order flow. Are there more buys or more sells entering the trading pit, entering the market? If there were more buys and I was a seller, I needed to go ahead and respond by raising my implied volatility level assumption, raising my options prices. Conversely, if more sell orders were coming in, if order flow was on that side, I wanted to lower my implied vol levels to adjust to which side order flow was coming on. And that's this market dynamics idea where the market is always trying to find the level of equilibrium. What level are there no buyers and sellers where everyone is comfortable? Now, that rarely happens. The market's always moving, and consequently, implied vol is always moving. But it's really driven by supply and demand and the bids and offers that are coming in from anybody, and then with the implied volatility being closely attached to that. Now, let's look at the pricing models. I'm not going to get too deep into the math, but maybe gloss over it somewhat. First of all, just want to outline what these pricing models represent and what their purpose is. They can be helpful in establishing some sort of baseline or reference point for an options price. Whether you're buying or selling, you might want to have some way to evaluate or interpret what the open market value is. Is it overpriced, underpriced, or priced just right? And these formulas can help you do that and remove just some of that raw emotion or uncertainty from making your trading decisions. But these models don't lead to decisions, they lead to an analysis. And it's always important, whatever the model gives you, whatever you're using to calculate theoretical values, it's always important to reflect, to ask yourself some questions of humility and to make sure that you're not making investment decisions that are strict without reflecting back and asking yourself those questions. When your value looks different from the open market value, there's a reason why, and always want to make sure that you're evaluating that and adjusting accordingly. Let's get into the pricing models. There's a number of inputs: stock price, strike price, volatility, days till expiration, cost of money, and then you have calls and put premiums on the other side of that. I'm going to refer back to just this overall structure of how you have all of these inputs on one side, and then you have the output on the other. That's going to come up a few times today. Regarding the inputs, stock price is observable. We can see what that is in the open market. We all know what the strike price is. That's going to be fixed. days to expiration, everyone knows that as well. And the cost of money, the risk-free interest rate, specifically the risk-free rate between today and expiration date. That's the rate we're looking for. That's also a known number. Volatility is a great unknown, so that is where you would have to insert some expectation for volatility if you wanted to compute call and put premiums. Or conversely, if you can observe call and put premiums, you can then back solve for volatility, and there are a number of times where you might want to do that. By far and away, the most popular pricing model possibly in all of finance is the Black-Scholes pricing model. This was published in 1973. Prior to 1973, of course, options were still trading between buyers and sellers, but there was no foundation for how to calculate a theoretical value. It was more intuitive. Investors had an idea of what level they think the stock might reach at a certain point in time and tried to have a feel for what that might be worth to them. And buyers and sellers just sort of had more of a less concrete way of coming to an agreement on what price to trade an option at. In 1973, this pricing model, the Black-Scholes model, was published, which changed everything. Now, of course, we also know 1973 was when listed options were launched on CBOE. But to coincide with that, in the same year, the Black-Scholes pricing model was published. And here is the pricing model, certainly not something investors need to know by heart or be able to take apart and put back together. But just looking at this pricing model very quickly, I think it's rather interesting to just point out a few things. The formula you see there at the top is for a call option. C is the call option, and it equals, and if you can sort of gander at what these letters represent, with S being the stock price and K being the strike price, what you just see from an overview here is that the call option value equals the stock price multiplied by some distribution factor, some probability of a distribution of stock prices, and then subtracted by the present value of the strike price. That's what that K, and then you see E represent, E to the negative represents the present value of the strike price. So discounting the strike price down to today's dollars, and then also multiplied by a distribution of potential prices. And just at a simple glance, you can see that as the stock price movements increase, the call value will increase. Looking at these D1 and D2 factors that are involved, the sigma is the volatility. Sigma squared is variance. Sigma is volatility. Just look at D1 very quickly. Sigma squared is in the numerator. It's added to that value. So D1 will increase as volatility increases. Look at where D1 is in the call model. It's right there in the front term. As volatility increases, it increases that value in the front term attached to the stock. In D2, you're subtracting sigma. You're subtracting volatility, so it will decrease the value there that you get for D2. So just, again, at a glance at what these terms look like, as volatility goes up, the front term attached to the stock goes up, and the back term attached to the strike goes down. Everyone would understand that that increase in volatility would also increase the call price, and you see that in the formula. So I don't want to get too deep into these formulas today, but that's just maybe an overlook and say, well, yeah, that formula kind of makes sense. I see all these letters here that might be confusing at first look, but now you're starting to see that there is some logic to how these formulas play themselves out. Now, Black-Scholes listed or published in 1973 is only for European options. It does not include dividends. And of course, volatility would have to be assumed to be a constant number. If you're going to price an option out towards expiration, you would have to assume volatility doesn't change. If it did change, you'd have a new value. So volatility assumed to be constant. Using a log normal distribution of returns, this is as opposed to a normal distribution. Normal distributions assume an equal possibility of stock prices moving up and down. Log normal only will accept positive numbers. We're talking stock prices here that can't go negative. So stock prices would be log normal distribution, which skews the curve of the distribution a bit to the right. And you can see, assumes efficient markets. But before I move forward, back to the big limitation is European options only. Well, a lot of us are trying to price American style options, which are what equity and ETF options are. And that is when the Cox-Ross Rubenstein model might be used. Now, this is a binomial model. I'll get to that in a second, which is used frequently to price American style options, and it can account for early exercise and the effect of dividends. Binomial model means that this pricing model assumes the stock can move up or down at any given point in time. If it starts out at $100 today, well, tomorrow it can go up to 101 or down to 99. And then from that second tier, from 101, it can further go up to 102 or back down to 100. And from 99, it can go back to 100 or down to 98. You can keep building out these tiers, almost like branches that go out in time with potential future stock prices. And you can calculate a theoretical value for the option at each of those individual potential future stock prices if the theoretical value calculated is less than the intrinsic value of the option at any point in time, then the model assumes that either early exercise or selling that option would occur. Early exercise would be accounted for in those certain instances, and the value attached to that circumstance would not be the theoretical calculated, it would be the intrinsic value that it assumes the investor could capture. That's how this binomial model is able to forecast. A little bit more labor intensive with all these different future stock prices. I think most firms that use this model will go out 7, 8, or 9 tiers, and you can just see how labor intensive it can get as you grow out those potential future stock prices. But that's how it's done, and that's how dividends and early exercise can be accounted for and American-style options can be priced. It's a wonderful exercise to use a calculator when you're looking at these models and the effect of the changing inputs. Our website, optionseducation.org, has a very handy, useful calculator that you can use to learn about the inputs and the Greeks. You simply type in the symbol on the top left, you select American style option, and then add in all of your inputs, including volatility, including interest rates, and then calculate your call and put values. Changing those inputs and recalculating is a great way to learn. Another really handy thing about our calculator here is the ability to back solve for implied volatility. You see that on the bottom right of the calculator. You can select whether it's a call or put option and then input the option price itself. This is something you might get from observing the open market. Input the option price and then calculate, back solve what implied volatility level is attached to that price. And then you would know what level the open market is using. A lot of trading platforms also have calculators and do that calculation for you. But here's something you can do yourself that's a little bit more manual and might be a little bit more helpful from a learning perspective. That's pricing models using a calculator. And now, of course, you see all the Greeks up there, delta, gamma, theta, vega, rho. It's a good time now to identify and explain what each of those Greeks are and get an introduction to those first order tier Greeks. Before I do that, I just want to clarify that the Greeks have an effect on option price when you change one of the inputs. And they're only meaningful during the option's lifetime, and they have an impact on the option's time value. Certainly they affect each other. As one Greek changes, it will affect the value of the other Greek. So there's a tremendous dynamic effect between the Greeks, and you can take this analysis much more deep and more complex than we're going to do today. But the Greeks are, I've heard them described as like looking at the dashboard of your car. It tells you how things are moving, how things are operating, and sometimes it can flash off a warning sign that maybe you have too much exposure somewhere. And as I go through each of them, I'll identify where are they the greatest and least. the moneyness plays a big role. Moneyness being what's the in the money status, in the money, at the money, or out of the money. And where does it sit, this option sit versus the stock price, the near term versus long term. Again, the Greeks are different if you're looking at short-term options versus long-term. And here's the first order, list of first order Greeks, your most common Greeks that you've probably seen before, delta, gamma, theta, vega, rho. There are more Greeks than this. There are second order and third order Greeks, which take the analysis to different levels. As one Greek changes, what does it do to other Greeks? There's all sorts of different combinations that you can come up with and different Greeks that exist to do a deeper analysis than we're going to do today and that most investors might do with the first order Greeks. We're going to start with delta, perhaps the easiest understood Greek. Delta is the option value's sensitivity to stock price movements. And as I get started here with delta and the others, what I'll say is, the Greeks are not as complex as some investors might think they are. If you are evaluating the price of an options contract and you're thinking about whether or not that's too much premium or too little, maybe it's a buy, maybe it's a sell, how much time do you have to expiration, what might this option be worth if the stock moves X amount of dollars, you're doing a Greek analysis whether you realize it or not. And it really just comes back down to attaching the terminology to the analysis that you're doing. In this case, delta is how much is the option value going to change for each 1 point move in the underlying stock price. Stock moves up. What does the new option price look like? Delta tries to forecast that. Moneyness playing a big role in what the delta is for at-the-money options. Deltas are around 50%, or you might expect the value of the option to change by about half as much as the stock moves. 1 point move, 50 cents. And then just putting this into common sense and intuitive interpretation, deep in the money options, we have 100%. They're going to change one for one, dollar for dollar as the stock moves. The far out of the money options, changing very little. If you have a stock at $100 and you're looking at the call option strike price of $50, it might be worth $50. If the stock goes up to 101, that option is likely going to move that full dollar with it and be trading for 51. That's 1 for 1. On the other hand, with the stock at 100, the 200 strike call is so far out of the money. If the stock moves from 100 to 101, you don't expect anything to happen. No change at all in the option price. So that's where you have those low deltas for far out of the money options and the highest delta for in the money options. There's another definition of delta that I was taught when I started in the business. It's not 100% mathematically correct, but delta is also considered to be a very good approximation for the percentage likelihood that the option finishes in the money. And you can use that sometimes when you're trying to select a strike price, just as a broad gauge. Remember, the market is not directionally biased. It's just telling you a 30 delta option has about a 30% chance of finishing in the money. And some investors may use that kind of information to begin their analysis on what strike price they might want to buy or where they might want to sell. And you can use that a little bit maybe in your strike selection. Let's break out calls and puts. Calls have positive or long deltas. Now, there's a few different definitions for long and short. I want to clarify that right here. In the options space, when you buy an options contract and you own it, you are long the contract. And when you sell to open an option and you're short the contract, then you're short. That's what long and short means. They're long, you bought, short, you sold. There's another definition for long and short, and that has to do with market direction. Being long the market, meaning you're bullish and you want prices to go up to be profitable, and being short the market, you want prices to go down. Those are separate definitions. Long or short the contract, or long and short directionally. With respect to deltas, long and short has that directional meaning. Calls have positive deltas. That's a positive correlation to the underlying stock price. As the stock moves higher, you would expect the calls to move up or at least be influenced higher. Positive correlation. Stock moves down, call prices influenced lower. Puts, the exact opposite. If you're new to Delta, you may have to think about this for a second longer because it is the negative correlation that puts have. Owning a put has short deltas, so stock price up, put price down, and stock price down, put price influenced higher. I want to walk through the 4 outright positions that you might have. You can buy or sell calls or puts. If you buy a call option, you are purchasing a long delta option. That means you are long the call and you're long deltas. If you sell the call option, you're short calls. You're selling somebody else the long deltas. Selling calls is short deltas. Put options work the opposite way. Trying to remember that. So if you buy a put option, you're long the put option itself, but you've purchased something that has short deltas. Buying puts or going long put options is a short delta position. And conversely, selling puts, if you sell to open a put, you are short a put option, which is a long delta position. Selling a short delta to someone else and taking on long deltas yourself. Now, if you have multiple positions, you would just simply do the arithmetic and add them together. If you have a long 40 delta call and you did a vertical spread, you sold a 30 delta call, you're net long 10 deltas. It's that simple. If you bought a 40 delta call and you bought 3 of them, add those numbers together. You're long 120 deltas. Stock moves up $1, you would expect your position to potentially increase by $1.20. You can just do that arithmetic with the more positions that you have. Now, deltas are going to change. Is one thing that we've said before, and I want to repeat, is that the Greeks are estimations assuming that everything else remains constant, which really is never the case. Things are always changing. Deltas themselves are going to change as the stock moves. The anticipated change of delta is what gamma is trying to forecast. The delta itself, the delta's sensitivity to the stock price, all else equal, when the stock moves $1, what is that going to do to my deltas? How much are they going to change? That's what gamma is trying to compute. Only options have gamma, and the gamma is greatest for at-the-money options. Again, think of that extreme example. You're comparing stock at 100 to the call option price to strike at 100 versus the call option strike price 200. If the stock goes from 100 to 101, the option delta is going to change. It's going to go from 50 to 52, 54. It depends how close you are to expiration. More on that in a bit. But it's going to move. The delta of the 200 strike call, that's not going to go anywhere. That's not going to change. It was 0, it's still 0. The 50 strike call, it was 100, it's still 100. That's not going to change either. Gamma is greatest at the money. Sensitivity in delta to stock price movements is greatest at the money. Similar to what we just did for delta, let's look at calls and puts. It's the same for calls and puts. Gamma for calls, as the stock price goes up, you would expect the delta to increase by the gamma amount, by the amount gamma is suggesting delta to change by, and it's going to constantly be changing all the while the stock moves. Stock price down, your delta is expected to decrease, and gamma will predict the magnitude of that decrease. Puts, again, we're looking at the opposite with stock price going up, our deltas decrease. Stock price going down, deltas go up. The delta of the option itself goes up. Now, when you buy options, you're going long gamma. Buying options, generally speaking, means you need movement. You want movement in the stock in your favor, and that's what you're trying to accomplish. When the stock moves up, say you buy a call option, you want movement higher so you can have those deltas and the gammas working in your favor. If you buy a put option, you want the stock going down. Remember, when you bought a put, you bought short deltas. If the delta itself goes higher, you now own more short deltas. Your shorts are getting greater, so you're getting shorter and shorter delta, and that's what you want. You want movement. Gamma, long gamma positions are trying to capitalize on stock price movements to a magnitude that's greater than you lose by theta or time decay. Just about to get to theta, and that's what you give up when you buy options, is theta and time decay. You want gamma to overcompensate the loss from time decay. Long options is long gamma, short options is short gamma. I'd mentioned at the money versus in and out of the money before. Now let's also look at days to expiration, near term versus long term. The 1 month option closest to expiration. We have stock price at 60, looking at the 60 strike call option with 1 month to go, or even shorter than that. As the stock moves from 60 to 62 to 58, the delta is going to be changing significantly. On the other end of that scale, going out long term, maybe 18 months till expiration, if the stock moves from 60 to 61, 62, that delta is really not going to change a whole lot. There's less sensitivity. So putting these two pieces together, gamma is greatest at the money, and it's greatest for short-term options. Again, that becomes clear when you think of expiration day and the stock trading at a particular strike price. As the stock moves above it and below that strike, on expiration day, the delta of that option is going to be changing to a tremendous extent, up to 100, down to 0, and back and forth. So gamma is then great. That's what you might have heard of as being referred to as exploding gamma on expiration week, that concept that the at-the-money near-term options are the ones that have the greatest gamma. Try to capitalize on gamma as an option buyer at the expense of theta, or time decay. Theta is the option value's sensitivity to time, the expected change in option value, specifically the decrease in value per calendar day, not per trading day. So it is true that over a weekend or a holiday weekend, you get all of those days coming out over the weekend, 3 days, maybe 4 days. But be careful if you think that a good trading strategy would be to sell options on Friday because you get the weekend taken out for 3 days and then you come Monday morning. It certainly could work, and you may find that it works more often than it doesn't. However, you really are taking that weekend risk, 3 days of risk of something happening from a micro or macroeconomic perspective. Anywhere around the world, you have 3 days worth of news that can come out to move the market. That is more risk than just 1 day. Also, when times are quiet, and I'm reflecting again back on my trading days as a professional, on Friday afternoon, if the markets were quiet, nothing was expected, as a professional, I started to take out the weekend on Friday, late morning, early afternoon, and was looking at option prices that were being calculated with 3 days less till expiration. Even when I was trading Friday afternoon, I would just tick those days out and set my bids and offers, making markets around theoretical being calculated with fewer days. The idea there is, 3 days do come out over a weekend, but it's not as simple as thinking sell options on Friday and buy on Monday. There's a few details that you have to consider there. Calls and puts both have negative theta. They both decay from one day to the next. So generally speaking, when you buy options, you have negative theta, meaning theta is working against you. And when you sell options, you have a positive theta position, or you might say positive theta is working in your favor. So long options, negative theta; short options, positive theta. Let's look at an example. Options trading today at 350, and the theta is 3 cents. There is nothing complex about this. The expected value tomorrow is 3 cents less. The expected value 10 days from now would be just taking those 3 cents and multiplying it by 10, or taking 30 cents out. Now, I can tell you that will not be correct. I have that up here for a reason. 10 days from now, the expected value that we're looking at that Theta is telling us is 320, but that will not be the case because Theta today is going to be different from Theta tomorrow, the next day, and next week. So it's the best we have to forecast on, but as you move out days and market forces and dynamics change, then the 10-day number is going to be different. Regarding the rate of time decay, you see in the money options that have very little time value are gradually approaching parity, so their decay is much more linear. But for at the money, and these are options that are close, the strike price is close to where the stock price currently is, you have a much more dynamic rate of decay curve. It's right around 40 days till expiration is when you'll see the rate of decay really start to pick up in the options contract. And the rate of decay continues to increase as you get through expiration week and expiration day. It gets faster and faster. Buyers and sellers of options are trying to find the optimal spot along this curve for them as they compare the rate of decay with the option price itself. An option buyer might be willing to accept a very high rate of decay if the price itself is small enough to make it worth their while to take that kind of long gamma, long option position. An option seller wants the fastest rate of decay that they can get while also getting enough premium to make those obligations worth their while. It may not be worth it to sell options that are decaying very quickly on expiration day or expiration week if there's not value there. And I do want to highlight that one point right there about the last week, the last trading day. Going back and thinking about that, the trading pricing models and all the inputs we had earlier, stock price, strike price, interest rate, days to expiration, volatility, and then you calculated the option price. You will often notice that small option premiums, far out of the money options, particularly put options, do not decay very quickly as expiration approaches. They maintain a low amount of value, and that's because it's just not worth selling options oftentimes for some investors. For a nickel or a dime or a quarter, it might just not be worth selling there. Now, thinking about implied volatility for a second, each strike price has its own implied volatility level. And you can plot that on a graph. Some of you may be familiar with that volatility curve, the way it looks. But if you have these cheap put options that are a nickel bid from one day to the next, and the bid's not changing, and the midpoint of the bid ask isn't changing, but Theta is telling you this option's supposed to be decaying, but it's not. Think about the pricing formula. We know the stock price, the strike price, the interest rate. The days to expiration are coming down, and the value, the result, the call option, in this case the put option price, is not changing. If that happens, the only way to make that math work is to raise the implied volatility level. And you may notice this on a regular basis. As expiration approaches, those cheap, far out of the money put options tend to see their implied volatility levels go up. The volatility skew will steepen, and it has nothing to do with the option prices going higher. They're just not decaying down to zero because they've reached such a low value that the market participants don't see it worth selling at those low values. That's another instance of when you might see Theta not being correct. It suggests a certain amount of decay, and you don't actually witness that level of decay. When that happens, you might see implied volatility levels increase. Another question that comes up frequently with respect to time value is, when does it happen? I see these numbers. They say, this is the amount of decay I'm expecting from one day to the next. Do they come out at midnight every day or at the closing bell every day? And the answer that I give to that is, time decay is happening constantly. Think about expiration day. An at the money option may be trading for 50 cents at the opening bell. If the stock does not move anywhere, by the time you reach the closing bell, that option will have decayed to zero. It lost all of its time value during the trading day. hour by hour, minute by minute until you reach that closing bell. Time decay is always occurring. It's constant. However, when you go out some weeks or some months, it's really such a small amount that you really don't have to be concerned about the fact that it's decaying on that continual basis. So you look at the one-day number and you get a good idea of what decay might be from one day to the next. So there's delta, gamma, theta, time decay. They all tie together. They all can affect each other. Now let's look at vega, which is the Greek attached to implied volatility. Again, the definition of implied volatility is the level of implied volatility that justifies an options price. It's the implied volatility level expected between today and expiration date. Vega is the Greek, which forecasts as implied vol changes by 1 percentage point, what might the option value change by? And arguably, this is the Greek that has the greatest effect on option prices. The first thing I'll point out is you see that 1% point change. Well, oftentimes, depending on circumstances, you can see changes in implied volatility that are much, much greater than just 1%. And using the calculator that we had up earlier, changing implied volatility levels, moving them around by 5, 10, maybe even 20 percentage points, see what kind of effect that has on your option. You can change the stock price, change date of expiration. It's a wonderful way to try and forecast or get a grasp on how implied volatility, and all the Greeks for that matter, change option prices as those inputs change. Calls and puts both have positive vega. If implied volatility goes up, then the range of potential stock prices also goes up, and that will cause as implied vol goes up, the options themselves will increase by their vega amount. As implied vol decreases, the range of stock price, potential future stock price expectation is going to shrink, and option values decrease by their vega amount. Buying options is going long vega, buying vega. You want volatility to go up, that works in your favor. Going down works against you. If you sell options, it's short vega, short volatility. You're selling those long vol positions to someone else. Long options, long vega, short options, short vega. I'm going to tie all that in together at the end. But let's look at an example of vega in action. Earnings is the best time to watch this and to see its effect. Here you have pre-earnings stock trading around 100 and a couple weeks to go to expiration, implied vol trading at 50%. Just look at the call value, the 105 call trading for $1.85. Now, before we look at post-earnings, I want to say one thing. It is common to recognize that prior to earnings, implied volatility levels tend to go up. Some of you may recognize that or have heard that and might be thinking, well, if that's the case, couldn't I buy options a few weeks before earnings and then sell them a day or two before and capture that implied volatility increase? And the answer is, I would say not necessarily or probably not, but it's not that easy. Think about that explanation I gave earlier about the cheap put options approaching expiration. They're not decaying. They're not going anywhere. As days are coming out, option value isn't changing. The only thing you can do to make the math work in the formula is increase the implied volatility level. The same type of thing that often happens in stocks before earnings. Days are passing. Theta is suggesting that this option should decay by a certain amount, but because of earnings and the investing public, market participants may be a little bit more reluctant to sell options. Those values hold a little bit stronger. They may actually decrease a little bit, but not by as much as Theta was suggesting. When that happens, implied volatility has to go up. Again, Theta being incorrect, implied volatility going up to compensate for that. So even though implied vol is going up prior to earnings, it doesn't mean the option prices themselves are going up. It could just mean that option prices are holding steady or possibly even decreasing just a little bit. Now, back to our example, we have this situation, stocks at 100. Now, earnings comes out, 10 days come out, and we get the move in the stock we're looking for. If we bought these calls for $1.85, stock at 100, we got a 5% move in our favor. However, you have the conflicting forces here. The stock price moving up has a positive influence on the option price, but days to expiration has a negative influence, and the drastic decrease in implied volatility has a negative influence on the option price. So despite a 5% move, we experienced quite a sizable loss, a 70-cent loss on this trade that we spent $1.85 on. And that's something you can see. And when it comes to earnings, you'll see the implied vol drop like this. And back to our calculators. If you want to know, hey, I bought this option for $1.85. Let's say implied vol goes from 50 down to 30. Where do I need this stock to go for me to make the kind of money that I'm looking for? Now, this example is not to say, hey, don't buy options before earnings. What it's showcasing is if you do buy options before earnings, you want to have a pretty good idea of where the stock needs to go if implied vol drops to a certain extent. And you can do the same type of analysis if you're thinking about selling options to capitalize on that vol crush. You can also then look, well, what kind of stock move would it take to hurt me? And you can do that kind of analysis from both sides, both the long side and the short side of the contract. Then the last Greek on the list I have here is rho, which is the option value's sensitivity to changes in interest rate. It's certainly considered the least significant because it has the lowest impact. Similar to what I said before about Vega, that 1% point change will often implied volatility is changing by a whole lot more than 1%. Well, the opposite is true here with rho. Not only is it a relatively small number, but you're not likely to see interest rate changes by 1 full percentage point. They change at a fraction of that amount. But rho is very important within the pricing models. It has to be there, expressed in decimal form, and represents the actual cash amount per option contract that you would expect the option to change as interest rates change. The higher, we're talking about cost to carry here and interest rates, the higher priced options have the most rho to them. Those are the in-the-money calls and the in-the-money puts. So the longer dated options, changes in interest rates will have a greater effect. And with respect to the direction, maybe this is one of the key takeaways with rho, is the direction of where calls and puts would go as rates change. I think the easiest way to think about this is to put it in terms of the future stock price with no directional bias whatsoever, just the future value of today's dollars. If the stock's trading at 100 today and the 1-year interest rate is 1%, the future value of $100 is 101. And that would be the expected future value of that price. If interest rates go up to 2%, then the future value is 102. The future value of the stock in future dollar terms is going higher. As rates go higher, obviously that's going to increase calls. As that future value goes up, calls go up in price, puts go down, and as rates decrease, the future value of that stock will decrease along with it, lowering call prices and increasing put price. The last thing I'll say here to tie this into other concepts with respect to that future stock price, it includes interest rates, the cost to carry, and dividends. So we didn't get much into dividends today. I'll forecast that for next week. We're going to get into dividends quite intensely with next week's session. The future value of the stock price includes cost to carry, that involves interest rates, also dividend payments, which decrease the future value of the stock price that you might expect to see as those dividends are paid. And then, of course, early exercise plays a role there. We'll get into a lot of that next week. Putting all of these Greeks together, the options price is a function of stock strike. Well, that's delta and gamma. That's the movement of stock price to strike price. The intrinsic value there is sensitive to stock price movements. And then you have Theta, Vega in row, and then of course dividends plays a significant factor in what that future stock price might be. Now, with respect to all these Greeks, perhaps one of the most common questions I get is, what's the most important Greek? And that's a tough question to answer, because I said they all play a major role, and implied volatility is the great unknown, and that's attached to Vega. If I were given a choice, or say when asking investors or professional traders this, if they were given a choice, I can only see one Greek. That's all I'm going to get is one Greek. Which one is it going to be? Well, perhaps you might want to understand and get the gamma as that one Greek that you would like to know. And when we walk through these Greeks one by one, when you're long options, you suffer from time decay, and you're long Vega. Well, gamma is going to tell you whether you're long or short options. Long options is long gamma. Short options is short gamma. So if you know your gamma position, you have a pretty good idea of what your exposure is with respect to time decay and volatility, and you know which direction your delta is headed. You might not know what it is right now, but you know where it's headed. So if you have an idea of all of those other Greeks just from that one gamma number, then you've got an awful lot of information that you can pull from. Again, have to reemphasize this. The Greeks are estimating potential changes in option prices as you change an input. They assume all other factors remain constant, which is unlikely to ever be the case. But they do help investors predict changes in pricing. And if you do want to learn more and utilize this when you're forecasting potential future option prices of positions you have, an options calculator might be your best friend in order to use the Greeks in their most effective way. We've got a lot more information on the Greeks at our website. Come check it out and utilize the investor services team at options@theocc.com. I can see Ken and Bill have been busy answering a lot of your questions here today. Send those guys an email and tune in and sign up next week. The manager of the investor services team, Mark Benziquin, will be presenting next week on dividends. I highlighted that a little bit today. That'll be next week's session. Follow us on social media as well, please, and check out our YouTube channel with a lot of our archived webinars. Now, let's see what questions might be dangling out there. I do see a couple of questions here. Well, one of them is asking, where does the interest rate come from? We'll just elaborate a little bit there. The interest rate is the risk-free interest rate between today and expiration date. And many investors, or I should say, between today and expiration date, or as close as you can get encompassing that time frame. And for example, a 1 month option, you'd be looking at the risk-free rate looking out 1 month. And a lot of firms, a lot of professionals might be using the LIBOR rate, that's the London Interbank offered rate, to get that number from, the rate at which banks charge each other to loan money. Now that might be where a lot of firms are getting that risk-free rate from. So you might want to look a little deeper into exactly where to find the rate, but in general, LIBOR could be used frequently, and what you're looking for is the risk-free rate of return on your money that you can earn between today and expiration date. Let's look at another question on gamma scalping. So sure, let's get into this just from a definition perspective and a short description of what gamma scalping is. Gamma scalping is trying to take advantage of stock price movements and then re-hedging position. So you start with a hedged position, and you by hedged position, I'm saying you're delta neutral on your position. Now, if you're long an option and you're hedged delta neutral, and the stock starts to move, well, of course, your deltas are going to change. And to state this in a general sense, as the stock moves and you re-hedge to go back to a delta neutral position, and your long options, As the stock moves up, you're going to have to keep selling shares of stock in order to re-hedge back to zero. And then as the stock comes down, you'll have to buy back shares of stock to re-hedge back to delta neutral. Now, real quick, if the stock shoots higher and you sell stock to go back to delta neutral, then the stock sells off and you buy shares back, you have just scalped shares. That's what gamma scalping is. Now, it's a lot harder than it sounds there because it takes skill and it takes a lot of experience to know when to execute your hedges, how often, and knowing what magnitude to let your deltas run. Remember, as the stock moves up, if you're long options, it's working out. Say you're long call, stock's moving higher. That's working in your favor. The longer you let that run, the more and more money you're going to make. If you let it run too far and the stock turns around, you miss your opportunity to sell shares and execute that gamma scalp. So it really is a technique and skill and experience knowing when do you hedge. You want to let them run as far as you can. You don't want to hedge too early because you know you're suffering from time decay. You need to capture that back. So you don't want to hedge too early, but you do want to make sure you get your hedge off. And then same thing on the other side of that. Now I can tell you, as stressful as that might be, deciding when to hedge and when to scalp, it could be a heck of a lot more stressful to be short gamma. And on the other side of that trade, when you're a professional firm, and I've been in this situation many times, trading professionally, short gamma, you're still hedging your position, you still want delta neutral, but as the stock's moving around and you're trying to re-hedge your position, every time you do that, you're scalping at a loss. And that's short options, short gamma, scalping for a loss every single time. You don't want to do that, but the more you let the stock run without scalping at a loss, the worse it can get if that stock keeps going. That can be really stressful. So gamma scalping is certainly a more complex technique that does take some experience and takes some time to develop a feel for just when am I going to execute these hedges and these re-hedges, but starting delta neutral and then continuing to go delta neutral as you move forward. Let's see if there are anything else kind of coming through. I do see loads of questions popping through here at the end. Let's take a look at a few more if I got a chance. Okay, in your definition of implied volatility, you referred to implied. Can implied volatility be calculated using the stock price history alone? What's the difference between implied and regular? Okay, let's differentiate between historical and implied volatility. Historical volatility is looking back at what the stock price did 10 days ago, 30 days ago, 90 days ago. That's the historical volatility of the stock. Implied volatility is different. It's looking forward from today, looking forward. What is the future volatility of the stock going to be between today and expiration date? Historic looks back, implied looks forward. Now, certainly, you can use the historical volatility as a guide to help you set the implied volatility level, but you really got to look forward. What has this stock been through over the past 10 days, 30 days, 90 days? Or what hasn't it been through that it's going to go through in the future? So historic volatility has some value and plays a role in helping guide an investor towards setting an implied level, but ultimately you're looking forward to determine, is it going to be consistent with what we've seen in the past? Might it be higher or might it be lower for various reasons? And then once that level is set, when I was on the trading floor, we would set implied volatility levels for new expirations or new listings, and we'd start the day out with relatively wide bid-ask spreads because we're not really sure, is this level a good level or not? As order flow came in, we made adjustments. We felt more comfortable with where implied vol should be, and over time, that order flow, that supply and demand, is what drives some of that level of comfort in knowing that your implied vol is set at a good level. We're bumping up on the top or on the 1 hour time frame. I can see just lots of questions came through just at the very end, last few minutes here. Ken and Bill working feverishly to answer those. All those questions will be addressed and answered. The investor services team will get to them as soon as they can. If not today, you will be getting an email with an answer from those guys. So keep your eyes open on your email for that. Again, please take the survey if you could. Hopefully everything came through. I saw a few comments about audio working in our environment here today. Hopefully it worked for most of you. Maybe some of you might need to go back to that recorded version and check that out. So hopefully you all enjoyed the presentation. Please take that survey, and don't forget to register for next week, July 15th, when Mark Benzaquin is going to talk about dividends and options prices. Thanks everyone for attending. Check your emails if you sent a question out, and we'll see you next week.